On March 27th, President Donald Trump signed a $2 trillion stimulus plan aimed at combating the economic consequences of the coronavirus pandemic. But the bailout comes with strings attached: a ban on share buybacks and dividends for any company receiving a government loan from the stimulus package. The ban will last the term of the government assistance plus 1 year. This clause was added after critics argued that companies like Boeing and airlines have spent too much money buying back their own shares from the stock market, money they could have been saving for a rainy day. We'll explain, but first, you have to understand how buybacks work. In 2017, Trump's tax overhaul left companies flush with cash. Over the following 2 years, companies on the S&P 500 bought back an estimated $1.5 trillion of their own shares from investors.
The purpose of the tax cut was not directly to encourage stock buybacks. The purpose of the tax cut was to encourage companies to bring money home and put it to more productive use in the United States economy.
In common share buybacks, the company buys back shares on the open market, leaving fewer shares outstanding. This boosts a metric called earnings per share, or EPS. EPS is calculated by taking the company's net income and dividing it by the number of outstanding shares. When the divisor shrinks, the EPS goes up. Higher earnings per share makes the stock look more attractive to investors, which can push up the share price.
There's a raging debate about, the benefits of buybacks and how they work. But I think the people who support them would say, first of all, that they do benefit shareholders, and shareholders don't have to be, rich people or hedge fund owners. They can be pension funds who pay money to wide ranges of people, including a lot of organized labor. They also, according to the advocates, benefit the economy as a whole. Critics of buybacks say it's part of a whole distorted incentive system for corporate America. They say that a lot of it is related to the fact that corporate executives now themselves get paid with stock. The reason that has evolved over time was to try and more closely align the incentives of CEOs with shareholders. But it also, in the minds of buyback critics, has created a perverse incentives where it's also given CEOs an elevated incentive to worry more about the share price than about long-term investments or investing in their workers.
Buyback activists saw the stimulus package as an opportunity to implement limitations. The stimulus sets aside at least $50 billion for cargo and passenger airlines, and $17 billion for businesses deemed critical to national security, such as Boeing. This comes after the coronavirus pandemic caused a severe dip in ridership, sending shares into freefall. Critics point out that over the past 10 years, the biggest U.S. airlines have spent 96% of their free cash flow on buying back their own shares. American Airlines said it's put considerably more money into capital investments and its team than buybacks in recent years. The aircraft manufacturer Boeing is also expected to receive aid from the stimulus package.
So the criticism about buybacks and corporate behavior are aimed at airlines and Boeing and some sectors looking for federal money, specifically because they are looking for federal money. The argument is that if you are asking taxpayers for funds, that first of all, we need to attach some strings so you're not abusing that money. A lot of that is sort of a hangover from the 2008 bailouts, where there was a feeling of banks got taxpayer funds and they used it to pay big bonuses to their executives.
As buybacks have increased in recent years, they've become a contentious issue in Washington.
Democrats have long favored restrictions on buybacks before this latest crisis, and they see this crisis in a way as an opportunity to begin to impose new government restrictions on them. Republicans in general have taken the opposite point of view, feeling like it's illegitimate for the government to weigh in, imposing new limits on how companies spend their money. President Trump, surprisingly in recent days, has taken essentially the Democratic view and has echoed their views that buybacks are not a legitimate way of using corporate money at a time of crisis.
Over $500 billion in support for the hardest hit industries, with a ban on corporate stock buybacks, which is something I insisted on.
The inclusion of an anti-buybacks clause in the stimulus package is a big win for those who oppose buybacks. But even with the stimulus in place, the U.S. economy is still shaky. Because of this, most companies are staying focused on liquidity rather than buybacks.
This is really a true crisis where companies are not as much worried about propping up their own shares as just preparing for their survival. In fact, at this moment, a lot of companies are canceling share repurchase plans, canceling dividends, trying to keep as much cash on hand as they can in order to make it through the next few difficult weeks and months.